Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to share with you a very high growth company. But before we do that, can you please give the video a like? And honestly, it helps. It takes about 2 seconds and definitely helps the channel. And if you have any questions, let me know. And if you have not subscribed to the channel, please do it. It really helps the channel. Okay. So before we talk about this specific company, I want to talk about what's happening in the market generally today. And when you look at what am I talking about? The consumer price, or the CPI, basically, if you like, okay, consumer price index in the US has actually dropped a little bit for the month of December, and the expectation basically met the expectation. This is what they were expecting, and that's what they got. So I thought because of that reason, I thought the stocks actually will go up quite a bit, but they haven't, and it's still not bad. I mean, it could be worse, I'll be honest with you. And sometimes when this information come out, they look for other things and the markets do not react. But again, we don't genuinely care what happens in the day-to-day of the stock market. For us as a long-term investors, we want to find good companies and hold them for a very long time. And that's what I want to talk about today, because the company I'm going to talk about today is not one of those companies that are, basically making money right now in terms of profitability side of things, right? But it's definitely a very interesting company. We're talking about a cybersecurity company, and that company is Palo Alto Networks. And this company provides a lot of cybersecurity solutions worldwide. They have so many different types of products that we actually use in our company and around the world. They have some of the top companies that they work with. They have software as a service, which is very good. And if you know me, you know I like software as a service subscription model side of things. And this is one of those companies that in the right industry right now, considering what's been happening in Russia and China and so on. So there's so many companies that have had breaches in there, basically in terms of their security, so they are trying to protect it, and these companies are in the right place. So for the next 5 to 10 years, I do believe this will probably be one of the best companies out there. So right now it's trading $139, $135 per share. It has a negative EPS, but I'll show you in a second, okay, in terms of where it's heading in the next couple of years. Okay, and that's the reason I want to bring this to you. It's not just because I felt like, okay, let me just explain this to you guys. It's because of the growth behind it. So although it's the EPS and earnings per share is negative right now, let's see where it's heading in the next few years. Okay, and EPS forward, okay, look at this. Okay, is right now basically for the next year they're expecting $3.42, and that's just a starting point, and I'm going to show you that in a second. Market cap is about $42 billion, so it's not a small company, but it's still growing, and it has a wide economic moat because of the products that they provide. It's quite unique in terms of their basically in terms of protections and so on. It is quite a high beta stock because, and this is very important, if you're thinking you're buying the Procter & Gamble's or whatever, you're not going to get that. You're going to get very high volatile company that will shoot up 5% upwards, 10% downwards, and so on. So this is why I said to you at the beginning, it's very important that obviously it's good to have these companies, but you need to know what you're investing in, and they're not basically for the faint-hearted. In terms of PE, obviously the E part does not exist yet, so that's why we will just have to wait. But price to free cash flow is 17.25 for a growth company. That's not actually bad. It's still growing, right? Free cash flow, we're looking at about $2.43 billion. In terms of profitability, we're not there yet, but return in the last 10 years has actually returned 24%, and I'm sure that's still a lot to do with price more than anything else, price appreciation. In terms of current ratio is just below 1, okay, but they should have enough to cover their current assets, basically more or less, if they need to or use some of the cash this company has. Again, we always talk about free cash, and it's very, very important. So in a situation like this, the company could actually dig into their free cash flow and use that. In terms of growth for the next couple of years, they're expecting 18% growth for next year, and then 25%. This is according to Yahoo Finance analysts that Yahoo Finance uses, right? And I'll show you from Seeking Alpha as well what they think. Current ratio, current price we've already seen, and their fair value in Simply Wall Street's valuation is actually $261 per share. That is 7% almost, 40% up, 47% upside. So it seems very undervalued at the moment. And when you look at this as well, from Morningstar, we're looking about £200 or $200, and then their valuation is about 31% discounted right now. Same goes for TipRank, for example, 64%, 65% upside. Same goes for Yahoo Finance, Seeking Alpha, 60%. So every single one of these companies have actually agreed. And remember, they might have same analysts and same kind of people sometimes, okay? Because obviously the banks that give those analyses are basically, they use that data from those banks. But the most important thing is that it seems very cheap right now from where it basically was about a year ago. And it's a strong buy according to Seeking Alpha. Now, talking about Seeking Alpha, let's go in here and I'll show you a couple of things. And one of the things that have basically attracted me to this company, okay, is when you look at the revenue from annually. So for every single year from 2018, they had $2.27 billion, and then 2.9, 3.41, and then 4.26, and then $5.5 billion, right? That is basically money they've already made. And the projection of the basically revenue estimates for the next couple of years, you're looking about almost 7, and then a year after 8.37. So it is heading absolutely the right direction. It's beautifully basically looking graph there. And then when you look at the earnings, if we look at annually and we take out the estimates, you can see 2021 July was basically a drop, maybe something to do with COVID, but it bounced back very quickly. If you include the estimates, you can see every single year they beat that estimate, and it looks like it is heading the right direction in the basically the next 2 years. So all of these things basically are, in terms of earnings are growing, in terms of revenue is growing. So let's have a look in terms of estimates from earnings, for example, side of things. So if you click earnings and then go to earnings estimates, when you scroll down, what you see is 2023 to 2024 and so on. You can see up to basically 19, from 40 to 41 up to 19. So if we look at just these 3 years, 35% growth, almost 17%, and then 18 or 9, almost 19% growth in the next couple of years. That's just the estimation for the EPS and year-on-year growth side of things. When we look at the revenue, is more or less the same thing, from 6.89 billion, okay, to 8 to 9 to 11 to 13, 15. And if we just stop the first 3, that's actually 25% growth, 21% growth, 19% growth. So this is the reason why I thought, you know what, it might be worth sharing with the community. And again, there's a risk that comes with it, because remember, these are what the analysts are expecting. This is not the normal. Basically, sometimes might happen, sometimes might not happen. According to Seeking Alpha, basically rating, they are saying it's a hold right now. According to the investors, okay, Seeking Alpha authors, basically it's just a buy. And when you look at the Wall Street, is actually strong buy, and their price target is $211. We've already seen about 55%, 56% upside, and the top end they're saying is about $268 per share. Average is 211, and the low end is 140, and right now is actually 135. So if you basically taking that into consideration, it's actually quite cheap when you look at it from that perspective, for a company that's going to grow about 20-15%. And like I've also always said to you guys, the risk with these companies is basically you buy it in when it's really expensive, and you will be in the red for a long time. I'm sure some of you have stocks like that right now in your portfolio. You might actually own Palo Alto right now, and if you do, please can you let me know if you own that company, and what's your basically average price for now. Okay, I own Salesforce. Is actually down quite a bit, and I don't know if it's going to bounce back anytime soon. Like I said recently, I will be adding to it just to average it down, because I do love the business model. Okay, this just the situation with the CEOs that I was not comfortable, but is basically Palo Alto is one of those companies that I genuinely think it is basically heading the right direction in the next 10 years. And also being in that industry, cybersecurity, it is very, very important, the company right now. One of the things that worries me, it's not even too much of a worry, because growth companies do normally do these things, okay, is the fact that they are issuing more shares. So they diluting your shares from 2013 up until now. They have been diluting the shares. And then, but the good news is total sales is actually heading in the right direction, it's going up. But when you look at this part, it kind of bit worries you. But as a, if this was Procter & Gamble, if this was J&J, I will be worried. But because some of these companies like to issue more shares so they can actually grow the business, I don't mind. Honestly, I do not mind. Even Salesforce is actually dilutes the shares and so on quite often. So I don't mind that side of things. So there you have it. That's the company that I wanted to talk about today. Just before we finish the video, I just want to talk about the Sharia compliance side of things. And this is one of the reasons I do like these companies. They don't have a lot of debt. So interest-bearing debt and interest-bearing securities is actually very, very low. And their business model is very simple. It's very easy to understand, for me anyway. And it is quite interesting business model, if you like. So there you have it. There's Palo Alto Networks. If you are interested in the company, go to their website, find out a bit more information. And obviously, the most important thing is do not take this as a financial advice. If you're still here, please give the video a like. Let me know if you own the company, if you're thinking about it. Would you ever own it? Would you ever get into cybersecurity? Do you work in cybersecurity? Can you tell us a bit more information on what might happen in the next few years and so on? It will be really interesting to have your intake. Have a wonderful day. I will be posting a couple of more videos in the next couple of days, and this weekend I'll be also carry on posting, even despite being at work. And sometimes whenever I get opportunity and I get some one of those 10-15 minutes of breaks and so on, I do jump on the mic and do the best that I can to help the community. And all I ask is just for you to give the videos a like, subscribe to the channel. Let me know if you have any questions. Assalamu Alaikum. Take care.